Welcome everyone, and welcome back to our lecture on the principles in banking. Last week we stopped after our discussion of risk measurement, and we now want to shortly discuss some different strategies for hedging risk, because these are the things that banks will employ, these strategies that banks will employ in their risk management to make sure that all risks that the bank is exposed to are adequately assessed and adequately handled in the bank. So we'll start with the very general discussion of what you can basically do to avoid and to manage risk. The first thing you can do is actually risk avoidance, meaning that you don't take the risk in the first place. Means in this context that, for example, you avoid risk altogether. For example, in proprietary trading, in investment banking, this could mean that you do not engage in a contract, you do not enter a contract, you do not engage in a certain transaction, you don't buy or sell a certain security. So if you just leave the money on the table, you're completely avoiding that risk. Could also be done in commercial banking. For example, if you deem a borrower to be too risky, you can simply say, okay, I'm not granting you a loan. I'm not entering a loan contract with you because you pose a too high risk for me as a bank. And usually this is not what we will do as a bank on a regular basis when it comes to investment in commercial banking. Now, we will leave some contracts and will not enter some contracts, like for example in this case of a borrower that is too risky, but complete risk avoidance is usually not what we are in as a company in this market for. Why? Because we want to do business, we want to earn a profit, and if you avoid all risks, then you will not earn a profit. So risk acceptance is, of course, necessary for any company in a free market. However, we want to avoid those risks that are extremely high, that are completely undesirable. Now, one risk type for which we do want to avoid all potential risk is op risk, is operational risk. Why? Because usually these are risks that are not directly related to any chance of earning a profit. For example, a fire hazard risk, the risk of a flood, any other natural catastrophe. So if we are able to prevent all these operational risks, that would be desirable, but not with, say, for example, lending or investment banking. The second general approach to deal with financial risks is risk diversification. So if we have partially opposite developments in value that compensate fluctuations in the value of the overall portfolio and that lead to a reduction in the overall risk, this is what we call diversification. We diversify our portfolio and we make sure that we don't put all our eggs in one basket. Now, at the same time, successful diversification will also not only lower the overall amount of risk, but it will also prevent the occurrence of clustered risks. In credit risk management, pretty simple idea. We grant loans whose probability of default is as stochastically independent of each other as possible, because if you have, for example, a linear correlation of 1 between two granted loans, it means that if loan A defaults, loan B will also default, and we want to prevent this from happening. So stochastic independence between the loans in our credit risk portfolio, that would be desirable. In market risk, we would consider correlations and also dependencies between the individual securities. Problem is that if we diversify business and credit risk, that may lead to higher foreign exchange risks. That could be a problem. And last but not least, if we are thinking about the three risk types from Basel II, credit risk, market risk, op risk, how can we really diversify operational risk? Usually this is not possible because we have some interdependencies between natural disasters, but how should we diversify? This is rather tricky. Then The next general strategy to counter risk is to transfer it or to sell it. Now, for credit risk, we can sell or reassign receivables. We can securitize loan portfolios or credit default swaps, etc. So these are two possibilities. We've already seen that credit and loan securitization has some appealing features in contrast to selling receivables or loans. Why? If you want to sell a loan or assign it to someone else, also Deutsch die Forderungsabtretung, der Verkauf von Forderungen, this can be tricky sometimes, legally speaking. Why? Because you need to find someone who's willing to buy this particular loan. You need to sign it over to that person, and you cannot just sell it on the market. Whereas if you securitize it via, for example, a mortgage-backed security or asset-backed security structure, you can actually make this marketable, and then you can sell a loan portfolio. Now, for market risk, it's pretty simple. You can close an open position, for example, by selling securities. And for operational risk, you can buy an insurance policy. And that is also part of a risk transfer. Why? You're not really changing the risk. You're not making it larger or smaller. You're simply selling it off to another market participant. You're transferring it to, in this case, the insurance company. Yeah. Okay. Now, risk reduction, risk limitation is yet another way of dealing with risk. For example, credit risk can be reduced by limiting the amount of credit lines granted. You can also simply limit the overall amount of loans granted, saying, for example, in this segment to corporate customers in, say, the shoe industry, we only want a total risk exposure of, say, 50 million euros. Then you are limiting risk, you are limiting the ability of your key account managers, of your bank managers, to grant loans, to take up new risk, and this is risk limitation and also, in a sense, risk reduction. You can reduce market risk. How? By entering an offsetting transaction, and this is what we call a hedge transaction, or simply a hedge. So we have, for example, if, for example, we have a stock market investment, and if we get into a derivative contract, these two transactions might each cancel each other out. And traders of an investment bank can also be limited in their trading. And as a rule, for hedging positions, usually financial derivatives are used. And this is why in the following we'll look at some prime examples of hedged transactions for you to see how this works. Now, let's first make clear and be clear what a financial derivative is. A financial derivative is a contract, is a financial asset whose value depends on an underlying financial asset. So, for example, a stock option is an option contract. It's a derivative whose value depends on the value of that particular stock underlying. And then the two most basic derivatives are an option, maybe even a forward future. A forward future, let's quickly go through these three types of contracts. An option is very simple. You have the right, but not the obligation to buy or sell the underlying. If you buy it, this is a call option. If you have the right to sell it, this is a put option. So we have a put and a call option. And then we also have so-called forwards and futures. A forward contract is the obligation, not the right, the obligation that you now agree with a contract partner. You agree to the purchase or sale of an underlying security, of an underlying asset. For example, let me just select someone of you. Someone of you enters a derivative contract, a forward contract with me, and I'm agreeing to buy 1 ton of steel at the end of 2021 for a fixed price of, say, 125 euros. So I've entered this forward contract. I have bought a ton of steel, and you have the obligation to sell me that ton of steel at the end of 2021 for this fixed price. Now, if the spot price, the current market price for this underlying steel changes, it might be that I'm making a profit or my counterparty, the other side who has entered this financial derivative, is making a profit. It's a zero-sum game. So if I lose €1, you will win €1. If I lose 15 euros, you will gain 15 euros. Okay, that's a forward contract. A future contract is a forward contract that is traded on an exchange and standardized. Same thing, just the standardized marketable version that is traded on an exchange. So let's do hedging. We will consider first a simple hedge strategy with the help of options, and we have an existing spot position. So we are in the possession of, let's see, an asset position of N securities. So let's assume for the moment that we have 12 Daimler stocks. That is our example. We have 12 Daimler stocks, and the Daimler stock price can go up and can go down. So let's see how this works with a one-to-one put hedge. So what we are doing, we have this position of N securities long. We are in possession of N securities, and we buy the same number of puts on the same underlying. Now what happens is, what is our value at time t when the options expire? So the options usually have a maturity of say 1 or 2 years. So what is our position in say 2 years? We can sell the stock price. We can sell the stocks. So we get the stock. This is actually for one stock. You simply have to multiply this with N to get the same for N stocks, but let's do it for one stock. So we can sell our stock. So we get the stock price S at time capital T. We get the price and the value of the put at time T. And we have bought the price, we've bought the put at 0.0 in time. So we have to subtract the price of the put. If we had no option at all, if we had no hedge, our value would simply be the stock price. But we are now adding the put, so we have to buy the put, and we can then see what the put is worth. The put is worth the maximum of X minus ST. The stock price ST, X is what we call the strike. That is the strike, that is the price for which, using which the option can be, I would say, I'm lacking the English word. You can let the option expire, or you can exercise, you can exercise the option. So because this is a put option, you can use the option to sell the underlying, and this is the price you would get if you were to sell the stock underlying or via the option. So you will get X, you will have to pay the current stock price to get the option that you're selling, and if this is negative, you will simply let the option expire. So the payout profile of the put option is the maximum of X minus ST, or 0, and then actually this is a typo, it has to be negative, right? We have to pay P0. And if you now combine this, depending on whether the final stock price is lower or above X, you get X minus P0 or ST minus P0. And what then happens is, you can see this here. Now, if the stock increases by 1, well, then if you only own the option, your position is worth €1. If the stock increases to 2, well, then you have €2. This is trivial. The put option, the Verkaufsoption in German, the put option has a payout profile that you get X minus P0. If the stock is worthless, you can sell it for X. You still have to buy the put option, but you will make the largest profit here. And at this point here, you will simply let the option expire. And then if you let the option expire, then you will slowly turn a loss, because you have to pay the price for the option P0 in the first place. If you now combine this, what happens is you get, let me just see if I have a line here. Can I draw a line? Just see, is there a... linear, yes, perfect. So what happens is this line here, this is our stock investment. And by adding the put option, you can turn this one up here at this point. And you have to pay a slight price for this. So what happens is that actually this one here, this line, tilts to this point. And this is the price of the hedge, so it looks like this. But even if the stock price goes down dramatically, you can see you're not losing everything. You're not here at 0, but you're here at X minus P0s. And this here, this is the effect of the hedge. So you're tilting this line here to this line, and this is how you get a hedging effect by adding one put option to your spot position in the stock underlying. Okay, so what is the profit function? If you now include the fact that you still have to buy the stock, well, then you simply have to move the stock investment to minus S0 here. And as you can see, this line again tilts to the above, and this one here, make a red line. This is now the new profit function of the one-to-one put hedge, and you're not losing everything here in this area. This is the hedging effect of a one-to-one put hedge. Now the one-to-one put hedge leads to an asymmetrical gain or loss position at the end of the term. So you're hedging against price losses, but you also miss out on some potential gains in this area, because if the stock had increased a lot, for example, if you had no put option, you would get this profit. Otherwise, you would get this profit. So you're missing out on some profits, and this is the price you have to pay for the added security of not losing everything if the stock price goes down. Right? Okay. Now, if you have alternative strike prices, X, then you have a trade-off that occurs between increased hedging against price losses and reduced participation in price gains and profits. With the put hedge, hedging can also take place during the term of your investment, and we can then distinguish American and European puts. The American put option can be exercised at any point in time. The European put can only be exercised at the end. So this is why you have to be careful. Depending on whether you're looking at a European or an American option, might be that you have this payout, or that you have this and you still need to discount the strike X. Okay, so what are the premises of this put hedge? First of all, the corresponding put, a put on the Daimler stock must be available. If you were to use a put option on the BMW stock, you would get what we call a cross hedge risk. You don't have the suitable option derivative contract available to do your hedge contract. If the hedging horizon is T, puts with at least the same term must be available, and if subsequent purchase of further puts may only be possible at a significantly higher cost. So if, for example, you have a put that is available until T, you're fine. Otherwise, you have to pay, you have to buy another option in between, and then obviously this effect would be somewhere here. So you have a higher cost of, say, 2P0, and this line also moves further to the right. Okay. And also, this is theoretical. Problem is, with many companies and many industries, like for example insurance companies, you are legally or based on regulations prohibited from entering into too many derivative positions. And some companies actually say, no, hands off, don't engage in derivatives trading. Does anyone know why? Any practical reason why companies are sometimes reluctant to use financial derivatives in hedging? Any idea? The problem is that as soon as you use just one financial derivative, you're subject to considerably higher regulation and actually financial supervision in most countries. And you fall, for example, under the European Markets Infrastructure Regulation, EMIR, and also additional sets of financial regulation. And especially small and medium-sized companies, not just banks, but especially this is actually true for energy trading companies, they will not use financial derivatives because the burden of additional regulation is just too high, and they try to use different ways in risk management. Okay, last but not least, if you use such a one-to-one put hedge and use a financial derivative, you have limited limited risk. And finally, you can also just accept risk. If you give out a loan, you're accepting the risk that it could default. So you have limited risk acceptance, and you accept residual risks in order to exploit advantages and in order to be able to make a profit. So that is always the case. Okay, so this is risk management in a nutshell. As you know, we have several additional lectures in the bachelor and master's classes on risk management, quantitative risk management, operational risk management. And if you don't have any additional questions, then let's continue with banking regulation, which is also highly relevant for modern day banks in any country. Okay, so we'll first start with the theory of banking regulation and then move on to systemic risk, regulatory frameworks, leverage ratios, the MA-Risk, die Mindestanforderungen an das Risikomanagement in Germany, and Basel 1, 2, 3, and last but not least, deposit insurance and bank runs. So we'll start with the theory of banking regulation. The premise here is, why do we need to regulate banks in the first place? Now, we have a free market economy, and as it should be in any free market economy, why should you regulate this industry in the first place? Regulation is never good. Regulation limits free enterprise. And why should we as a government have any interest in regulating the financial sector? Now, we've already seen some reasons behind regulation. Usually this is about investor protection. It's about depositor protection. It's about the proper functioning of the financial payments system. And because of the high importance of the banking sector for providing companies with loans and for making sure that the financial sector can properly stimulate and support real economic activities. Government has interest in preventing these crises via regulation, and it has to absorb the resulting losses in the case of an emergency. In the end, the central bank or the government will have to act as a lender of last resort if it doesn't want the financial sector, financial system to go down the drain. So the ultimate goal is to reduce moral hazard problems and to set incentives to act responsibly and not recklessly. In other words, vice versa. We do have moral hazard problems. We have incentives for bank managers to act irresponsibly and recklessly. And this is the overarching premise and problem here in banking regulation. Now we'll see that the equity ratio, or alternatively leverage ratio, is a suitable tool to address default risks of depositors And regulators will also look to reduce liquidity risk. That is, the ability of banks to perform maturity transformation should not be restricted. And this is what bank regulators will try to do. We can then, first of all, distinguish micro and macro-prudential approaches. It used to be, before the financial crisis, that banking regulation and supervision was micro-prudential. Bank supervisors only looked into individual banks, and they looked at the potential of this bank to go bankrupt, to default. No one, not really at least, not at this level, no one looked at the macro-prudential implications of one bank defaulting and maybe infecting other banks. And macro-prudential regulation is regulation that considers and looks at the entire financial system in order to limit systemic risks. Micro-prudential regulation and supervision is a supervision or regulation that only looks at the individual default risk of individual banks, but not at the system as a whole. And a rule-based regulation is then built on quantitative norms. It creates incentives of regulatory arbitrage. So this has to be regulatorische Arbitrage in German. And what can we say about this? First of all, a rule-based regulation means that the regulators set rules and say, well, if you cross this ratio, if you have an equity ratio that is lower, say 8% than 8%, you have to face this consequence. This is a rule-based regulation. Problem is that there are some works, some research papers that have shown that this creates incentives to regulatory arbitrage. Why? Regulatory arbitrage, first of all, is sourcing certain business and activities out to other countries, to other subsidiaries, in order to exploit differences in regulation. And if you set rules and you see, for example, we have this country here and we have an 8% rule, and here in a country where we have a 6% rule, then business within one company will be outsourced to this country because the regulatory norms, regulation is softer in this country. So this rule-based regulation is usually the standard nowadays, but it also creates incentives for regulatory arbitrage. But banks anticipate that banking supervision bodies will shy away from necessary interventions and sanctions, and this means that the disciplinary effect of regulatory measures is at least sometimes lost, because we all know no regulator and no supervisor would close down Deutsche Bank. No one will close down Citigroup. That will just not happen. Okay. Now, I've already mentioned one main justification for banking regulation is creditor protection. So a bank is not a monolithic block, but a coalition of many participants who partially pursue different interests. They have different stakes in the company. And the various parties involved are, first of all, bank managers, shareholders, and external lenders, creditors. And management will operate on behalf of equity investors, at least they should be. And managers in general, they also pursue their own purposes, their own goals. Next to, say, non-financial conveniences, for example, a very luxurious office equipment or a luxurious office, there is an aspiration to power, influence, and also higher compensation, and of course preservation of their own position and the control over their company. So this is empire building. I want a large company, I want to be the CEO of a large bank, and this is my empire. Problem is, you want to prevent an intervention from the outside in case of poor yield or poor profitability situation. So managers will try to block the influence from outside stakeholders, and they might also have an incentive to prevent an intervention from regulators. Then they could also follow the strategy of gambling for resurrection. What is gambling for resurrection? Gambling for resurrection is quite interesting. If, for example, this is the default barrier, So at this barrier, the company, the bank, is worth nothing. So let's assume this is let's say this is the level of debt. And this is what the bank is worth right now. This means shareholders will get this, and bondholders, other creditors, will get this. Now, if the value of the bank evolves like this, at this point, what happens is basically the company belongs to debt holders. There is nothing left to shareholders, and we have now two possibilities. Let's assume the company, the managers and shareholders at this point in time can now decide what to do. First possibility is, let's put it all on one number. Let's play roulette. And these are the two outcomes. So this is A, this is B. What is A, what is B? Maybe write your answers in the chat window. What is A, what is B? A high risk strategy, you're gambling. And what could A be and what could B be? You're all putting all your money on one horse. High risk strategy, and A and B are the two outcomes. What could happen? Any idea? No idea? Well, in case of B, high risk strategy turns out to be detrimental. Company goes bankrupt. Well, compared to, say, point C, shareholders and managers are the same. The company belongs to creditors at point C, and shareholders don't care. So C or B, I don't really care. I've lost my stake in the company anyway. But A, at point A, the debt holders will get the same amount of their debt back. But again, this is the payoff to shareholders. So this is gambling for resurrection. If the company is going down, at some point, shareholders and managers will just say, well, let's put it all on one horse. Let's put all our money on one horse. Let's try to gamble for resurrection. And in point A, we've resurrected from the debt. In point B, well, we've stayed dead. Okay. Equity investors, what are they interested in? They have as their main objective the highest possible return on invested capital. This goal is unproblematic in a situation where we have sufficient profits. In the event of low earnings and a high level of debt, we've seen, just like with managers, they have the same incentive if they are paid out based on shareholders' return. We also have an incentive to gamble for resurrection. And the behavior of managers is not stopped by equity investors. So shareholders and managers, they will gamble for resurrection. They have the same incentive. The external lenders, creditors, debt holders, they are entitled to the debt that they've given to the company. And in comparison with equity investors, however, the loss of debt investors is limited to, for example, if they are depositors, to the deposit amount and the profit on the nominal claim. So you only get your deposits back, tops, plus the agreed interest rate. Thus, lenders, creditors have no interest in a corporate policy with the highest possible return. They don't want the company to gamble for resurrection. They want the company to stay at sea, and they would simply say, well, pay me back my money. I want to get my money back before you can do something stupid with it. So they are interested in low risk measures, in low risk strategies. That's rather, let's say low risk strategies. Okay, so this is what creditors are interested in. In the case of highly endangered claims, the lenders will assume the same position as investors because we've already lost our money. Since the upper limit of nominal claim is barely attainable anymore, that is the case if we are already in point B, we know, well, everyone has lost the money. So we need to get back to this point, and then again, all income will be directed to the depositors, whereas losses are borne by lenders. Therefore, The objective for creditors, for depositors, is also to maximize the overall value of the company. And if you compare this to Merton's option model, the Black-Scholes model actually, which is also called Black-Scholes-Merton model, you can easily see this because you have a claim of the equity investors and claims of the external lenders of creditors to the firm value, and then you see that they have these incentives. So we need investor and creditor protection. So as long as the debt capital is not threatened by default, or only to a limited extent, the owners and management retain control of the bank. If the default risk of depositors, however, exceeds a critical threshold, the control, that's not command, but control over the company, is withdrawn from management, taken from management, and transferred. It's also withdrawn, rather is taken from management and transferred to depositors, or at least the representative authority of depositor, for it could be the state. And then the question is, to what parameters should a measurement of the default risk be linked, and how should the critical threshold at which the regulatory body, for example BaFin or Deutsche Bundesbank, intervenes be set? So to protect depositors, we will first set a critical threshold. Then we will measure default risk, and if default risk, our default risk measure, crosses this threshold, then we will transfer control of the bank from management and shareholders to depositors or to the government. First thing we could do is the debt to equity ratio. Now the debt to equity ratio is, as we know, an important balance sheet ratio for lending of banks, and it's simply the quotient of debt and equity. In this case, we've left it in German with the German Fremdkapital and Eigenkapital. You can also just call it debt over equity. So this is the debt to equity ratio. And we could say that debt to equity ratio should not exceed a certain upper limit, Q. That's fine. Note, this is the starting point for coming up with a quantitative rule and a rule based on banking regulation. We simply assume and demand that the debt to equity ratio is lower than a certain upper limit Q. Now the debt to equity ratio is used for the measurement of creditor default risk. The higher the risk, the ratio, the greater the likelihood that income from the company's performance activities will not be enough to guarantee interest and repayment of debt. A regulator should then intervene if a threshold value is exceeded, if this debt to equity ratio is higher than Q. So if we rewrite this as the difference between assets and equity in the above formula, so if we take total assets minus equity, this should give us debt, divided by equity smaller or equal than Q. We can see that if we now multiply this with equity and get equity to the other side, we see that equity should be larger than Q star times assets. And Q star is given by 1 over 1 plus Q. This is the threshold. In other words, what you can see is requiring the debt to equity ratio, in other words, a leverage ratio, to be above or below a certain threshold translates into a rule for bank equity has to be larger than what? A parameter Q star times the assets of the bank. And this is what is frequently done in banking. You will see that you are not looking at the assets, you will look at what we call RWA, risk-weighted assets. You will look at the assets, you will have certain risk weights, you will weigh those assets and then sum it up, and you require equity to be higher than your risk-weighted assets, or at least a portion of that. So a limit to the degree of debt thus translates into the requirement that your equity must be larger than a certain percentage of assets. And this is the rewritten question. In what amount must the assets at least be backed with equity? So you need equity, you need to calculate the risk-weighted assets, and this is a fundamental cornerstone of banking regulation. Now, how should we measure your risk-weighted assets? This is where the valued risk VaR comes into play. So as long as equity is available, at least equal to the valued risk, the claims of the depositors are secured with a correspondingly high probability. Then equity is sufficient, in other words, to cover the potential losses, and VaR has been legally acknowledged, accepted as a method to determine the required amount of equity to back market price risk for several years since Basel II, and it's increasingly replaced by expected shortfall, which we've already seen. Now, what happens is banking regulations for risk limitation are traditionally based on the fact that risk-weighted assets must be backed with equity to a certain percentage, and this is where the famous, infamous 8% from Basel II comes into play. So you have to calculate your risk-weighted assets times 8%, and this must be held in equity on your balance sheet. Now, the value at risk is, as we've seen, a downside risk measure, and the idea is that high losses represent risk and high profits pose no risk, so we don't look at them. Okay. Now, previously, the amount of assets was fixed and the required equity capital was determined. For banks, however, the reverse view is reasonable. We would argue that equity, at least in the short term, is fixed. We cannot change equity so easily, but what we can do is we can expand our business activity or we can contract business lending. Meaning what? If you see that, for example, we have equity equal to, let's say, 5 billion euros, well, this is the amount of business we can engage in, and then we can do more or less lending based on our risk exposure. And this is why regulators and supervisors will require us as a bank to have a financial risk management, because we need to measure those risks we are exposed to make sure that we keep enough equity on our balance sheet. Some other problems with equity and assets. Now, assets are exposed to various degrees of risk, and the endangerment of creditor deposits depends on the actual risk. Therefore, we need a weighting of assets by the degree of risk. We need methods for reliable risk measurement, and the risks of individual investments are less important than the risk of the overall portfolio, because equity is available at the bank level. We are also required to look at the portfolio risk of all investments at the bank level. So this is the difference between the portfolio view and the individual investment view. For capital management, we need to look at the overall portfolio risk. Now, assets should not be limited only to balance sheet assets, but to all risky positions. Question then is, what valuations of balance sheet assets are chosen, book values or market values? Well, book values usually serve the purpose of a cautious profit determination under German GAAP. Market value is, however, better suited to indicate the default risk of creditor claims, and also note the so-called gains trading to increase balance sheet equity without any material change. So this should be kept in mind. Now, what is the intention of a risk limitation standard? The alternative motivation is that we want to avoid moral hazard problems. For example, we have exogenous risks on which we as a manager have no influence on, and they should not lead to the loss of management control over the bank. The distinction now between macroeconomic and company idiosyncratic specific risks makes sense then, and only the company specific risk should be included in the risk limitation standard. And the purpose of this norms of risk limitation standards are that you want to form a risk buffer for potential losses. However, in addition to those risks that directly lead to losses, liquidity risks are also relevant. So it could be that you've assessed the risk of a financial loss and that you have managed your potential losses. However, if they lead to liquidity risk and your treasury is not up to the game, then you might face insolvency simply because you haven't adequately assessed and managed your liquidity risks. Okay. Then now next, let's look at the regulation of systemic risk. What is, first of all, systemic risk? Systemic risk can be defined as risks that are not identifiable or do not seem controllable at the level of an individual risk. They are not compensated by an aggregation across banks, but rather mutually reinforcing each other. An alternative definition, the first one of some alternative definitions, is the one given by the G10. Systemic risk is a risk that an adverse shock to the financial system, to the banking system, causes a significant loss of economic value in a sufficiently large number of banks, and now this is important, and that this loss of value has a negative side effects on the real economy. Without this last part of an effect on the real economy, we wouldn't be caring about systemic risk in the first place. Why? Because the financial system is systemic because it has a systemic effect on the real economy, because it can have an effect on the real economy. The shoe industry doesn't. The automotive industry, if we are honest, doesn't have a real effect on a large part of the real economy, but the financial system does. So this is why we call it systemic risk. Alternative definition 2, given by Adrian and Brunnermeier in their COVA paper, or Acharya, Richardson, Richardson, and I think there's a fourth author, I've forgotten the name, sorry. A bank's systemic risk contribution is the amount that an individual bank contributes to a potential undercapitalization of the entire financial system, which in turn then again causes an effect on the real economy. So we have exogenous shocks. They are just the triggers of a crisis. The crisis scenario arises from the reactions of banks to the shock. And the problem then is that individual banks do not consider the effects of their action on the stability of the whole system. And the solution is that in addition to microprudential supervision that tries to limit the default of this one particular bank, we also have macroprudential supervision in place that looks at the effects that could follow if one individual bank defaults. So microprudential supervision is the supervision of individual banks, of individual institutes. This is the traditional form of banking supervision, which primarily monitors compliance with qualitative and quantitative requirements at one bank, whereas macroprudential supervision is the monitoring of aggregated parameters and measures concerning a number of institutions, and the aim of macroprudential supervision is to identify, assess, and mitigate risks for the entire financial system. First observation, the granting of loans by banks runs cyclically to the economy. Let's correct this again here. This is, if we give credit, if we grant loans, to companies, this is cyclically to the economy. So in good times, many loans, not credits again, are granted without good reason. And in economically bad years, loan defaults increase sharply, and actually also good companies don't get a loan. So good economy, high lending, bad economy, low lending. And macroprudential supervisory now tries to pursue an anti-cyclical regulation. Regulations should be anti-cyclical. So you have stricter regulations during upswings, during a boom phase, and then weaker regulation during downswings. Why? Because if you assume that, for example, this is the economy, we have booms and busts, and if, for example, we have a recession, and then supervision steps in, and we have cyclical supervision and regulation, this means that the requirements on banks are set even higher, and the result will be that we have even fewer loans, and the crisis turns out to look like this. So weaker regulation during a recession and tougher regulation during upswings. Okay. And the same thing with anti-cyclical equity backing and equity capital requirements. Further approaches are based on the too big to fail effect. This means that banks that are too large together with our banks, too interdependent, too interconnected, must not default. And this provides an incentive for these large banks to take on high risks as, if they're in doubt, they will be saved from bankruptcy by the state. They will be bailed out. So too big to fail is a huge problem because it means that, for example, Deutsche Bank, case of Germany, Deutsche Bank knows that the German state will never let Deutsche Bank go bankrupt. So they can take on higher risk. They will exploit this fact, this implicit too big to fail guarantee, this implicit guarantee. And the approach of macroprudential supervision is systemic important institutes must fulfill additional capital requirements. Let's call this equity, not equity, but capital requirements. That's the correct term for this, capital requirements. Yeah. So we have tougher regulation for systemically important banks. So what are some criteria, not criteria, for systemic importance? First of all, size, total assets, economic importance, cross-border activities, cross-border linkages with the financial system, the substitutability of certain services, and the complexity when it comes to disentangling the bank in case of a bankruptcy filing. Now, in the aftermath of the financial market crisis, we've seen numerous measures that were proposed to assess the systemic risk contribution of an individual bank. For example, COVA, Delta COVA, marginal expected shortfall or S-risk, and all these measures, they are, at least in some topics, discussed in the numerous seminars, both at the bachelor but latest at the master's level. Okay, now let's look at the development of the regulatory framework. What should we do? Now, after some very spectacular and unfortunate bank failures during the world economic crisis, during the Great Depression, we saw the first types of banking supervision in Germany introduced in 1931. Now, numerous regulations were introduced, and they all aimed to minimize default risk for depositors by limiting the risks that banks can take. For example, default, credit, market price, liquidity, operational, and large credit risk. What is done is, first of all, risk limitation is implemented by capital requirements. We've seen, not in the 30s, but much, much later, the minimum requirements for risk management, die Mindestanforderung an das Risikomanagement, die MA-Risk. So risk-bearing capacity must be given, and we should have an appropriate business organization, and an appropriate risk management process must be in place in any bank. So there are special reorganization and settlement regulations for banks, meaning that you should have a so-called living will. And last but not least, besides legal deposit protection, most German credit banks, they are also members of an additional voluntary deposit protection scheme, deposit insurance scheme. Meaning what? Depositors are insured against the default of their deposits via, in this case, at least two deposit insurance funds. So let's take a look at the history again. Now, regulation of banks has, in every country, not just Germany, historically speaking, always followed spectacular collapses of individual institutions. For example, we saw in 1896 the adoption of a stock exchange and deposit law. Cause for this was the Berliner Bankenpanik at the end of the 19th century. We then had the supervision of mortgage banks. Again, the default of several mortgage banks was the cause for this supervision in 1899. And due to the freedom of trade, the German Gewerbefreiheit, meaning that you can take up any kind of business you like as long as you're qualified, we didn't have a general banking supervision at that point during the German Empire. In 1931, we had the decree of the first general banking supervision. and if you know a little bit about German politics at that time during the Weimar Republic, this was usually done, especially in the latter years of the Weimar Republic, this was done by emergency ordinance and executive regulation by the government, because parliament was no longer able to pass laws. And at that time, this was due to the closure and the default of the Danat Bank, the Darmstädter und Nationalbank, during the Great Depression. So this was the cause for the enactment of the first decree on banking supervision. So what were some consequences of the crisis? We had a panic withdrawal of bank deposits, a bank run. We had the introduction of so-called ordered bank holidays. This is quite interesting because in the UK, official national holidays are still called bank holidays. And what does it mean, a bank holiday? Well, it's an ordered bank holiday, meaning that since these days, nowadays it's done by BaFin, the Bundesanstalt für Finanzdienstleistungsaufsicht, the German Federal Financial Supervisory Authority, they can issue an order under paragraph 46 of the German Banking Act to temporarily close down an institution, a bank, for customer traffic. Meaning what? They can simply say, this bank is closed until next week. That's an ordered bank holiday. Bankfeiertag. And this is actually a euphemism for BaFin closing down a bank to prevent a bank run. Now, in 1934, this emergency ordinance from the Weimar Republic was replaced by the Reichsgesetz über das Kreditwesen by the Nazis. And then later on, only in 1962, this one was replaced by the German Banking Act that is still in place today, the Kreditwesengesetz, the KWG. Now, this was followed by a phase of deregulation. For example, we had an exemption of a fixed interest rate, certain regulations on competition of banks were abolished. And in 1974, the infamous Herstatt Bank went bankrupt. And the consequences of this bankruptcy was the introduction of the Principle 1a under the German Banking Act, Grundsatz 1a. We expanded deposit insurance, we established the 4i principle in management, and we tightened the regulations on large credits and large loans. Again, I have to say this is large loans. So Principle 1a, according to paragraph 10 of the German Banking Act, said what? It limited foreign exchange positions and it limited precious metal positions. Actually, Herstatt Bank went bankrupt because they traded too much in gold and steel and other metal positions in commodities, and also commodities that were quoted in foreign currencies. And they didn't have anything to do with this kind of business because they were a bank. So at that point, the German Banking Act stipulated that banks should not engage in too much business in foreign exchange positions and in commodities. Nowadays, this is regulated in the interest rate risk in derivatives contracts and price risks in derivatives. And since 1980, basically, German banking supervision has been changing at much shorter intervals. The reason for this is because we have European Union law that is introduced into German law all the time. For example, if we start out by the European Community, in 1984, supervision of credit institutions on a consolidated basis. In 1930, we had the implementation of the Solvency and Capital Requirements Directive. In 1995, we had the modification of consolidation and large exposures regulations. In 1998, the Investment Services and Capital Adequacy Directive. And nowadays, all these changes, they usually are initiated by the Basel Committee on Banking Supervision, that is located in Basel, obviously, with the Bank for International Settlements, the BIS. In 2004, we probably saw the largest change to banking supervision in the European Union. Basel II was the second set of ideas set forth by the Basel Committee, and this became famous as Basel II, the adoption of the International Convergence of Equity Measurement and Capital Requirements, Basel II. In 2007, We then had the financial crisis. At the climax of the financial crisis, we didn't have a run on the banks, but we had a run on repo. This was a quasi-bank run in the interbank market because banks tried to refinance themselves short-term by using repurchase agreements, Wertpapierleihgeschäfte, and these are in short called repos, repurchase agreements. This led to a crisis of confidence between banks, and we had a run on repo. The far-reaching changes in the banking regulation obviously followed after the financial crisis. The Basel Accord was transformed, was revised, was transformed into a EU-wide supervisory law. And what were the main approaches? Tougher capital requirements on some liabilities, additional capital buffers, systemic risk capital buffers, risk-intensive equity backing to limit debts, liquidity risk limitation by provisions on the holding of liquid funds and by limiting maturity transformation. We saw over-the-counter derivatives, which were quite intransparent and not known to regulators at the time of the financial crisis, led to the European Market Infrastructure Regulation, EMIR, that proposes a clearing obligation for standardized OTC derivatives and reporting obligations for transactions in OTC derivatives. So because OTC derivatives were not monitored by supervisors, they were surprised by the risk exposure of some financial institutions via their OTC derivatives contracts. So EMIR, the European Market Infrastructure Regulation, now requires banks to report these transactions. Another lesson learned was insolvency law. Bankruptcy laws was not suitable for large banks, and we needed to have living wills, and we need to resolve and settle these banks if they are too large. So in 2010, we had the adoption of a Banking Restructuring Act, and now we have the Bank Recovery and Resolution Directive in 2015 that are meant to make it possible to resolve these large banks. Now, one reason why some banks have taken excessive risk was excessive bonus payments to investment bankers. So the so-called institutional fee ordinance followed. And what we now have is a EU banking union, European banking union. European banking union is a word that basically that instills the idea that this is a union like the European Union. It is not. The European Banking Union is a word, is a concept that is meant to describe a unified European banking system. And what are the parts of this European Banking Union? First of all, a EU-wide uniform rules, and we call this the single rule book, meaning that we have uniform regulation within the European Union. Second, we have European institutions with their own decision-making powers. European Central Bank. Does anyone know which EU organization is responsible for insurance companies? Anyone? EIOPA, the European Insurance and Occupational Pensions Authority. And last but not least, we also have a European Union institution for supervising the stock markets and for stock trading. What is the objective? The separation of bank and public debt crisis. This all evolved especially during the Euro crisis, when we saw that the problems in banking in the financial crisis led many countries to bail out banks. That led to public debt, and we wanted to disentangle bank crises from public debt and the Euro crisis. Best results: ongoing banking supervision with the ECB and the CRR as a uniform set of rules. Bank settlement according to the Single Resolution Mechanism, the SRM. We have the deposit protection, on the other hand, as part of a harmonized deposit common fund. That is not the case, and this is was famously prevented by Germany. Germany and German politicians do not want a European deposit protection fund. Most notably Wolfgang Schäuble, at that time German Minister of Finance, and Germany prevented this to be part of the European Banking Union because we, as at least German politicians think, we don't want to pay for banking failures in Greece, in Italy, in Spain, and vice versa. So the national deposit insurance systems still remain, and we don't have this in the European Banking Union. Okay. Now, I know we only have about 150 slides left to cover, and because this is the last lecture before Christmas, I would say we can stop here for today before we start with the leverage ratio and then Basel 1, 2, 3, because this is a lot to digest. I think the last chapter on the foreign banking systems is relatively easy, and usually during a normal semester I would not even reach this point, and usually I will stop at the end of chapter 7. But I'm pretty confident that we'll reach the end of this set of slides by the end of January. So I think we, as an early Christmas gift, we can stop here for today. So do you have any questions? Anything that is still unanswered, or any comments you might have? So if you don't have any questions, thank you for your attention. Have a nice holiday, stay safe and healthy, and then I will see you next January in 2021, which will hopefully be a much better year than 2020. Okay, so bye-bye and take care.